Well, good afternoon. How are you today? Are you in the United Kingdom right now? Perhaps you could turn on your microphone just for a moment.
Hello.
Hello. So, how did you hear about this course in the UK?
Oh, Eventbrite.
I'm sorry?
Eventbrite.
Oh, okay.
Yes,
Uh,
I watch some classes online. It's very interesting. So I'm always research about small business, and I found that I thought it was interesting. So
well, very good. Well, we have a few other people who are joining us now. It officially started at 12 o'clock, so I want to welcome you all to the program Accounting and Tax Issues in a Small Business. Hope you all are in the right place with the right link and the right material. If y'all just turn on your microphones just for a moment so I can make sure everybody's devices work. Daryl, thank you. Chris is connecting. Kaya, is it pronounced Kaya or Kia?
Kia.
Yeah, thank you, Kia. Did you all get the material, the PDF?
Yes.
Yes.
Good deal.
Yes.
Good deal. And you're welcome to leave your microphones on, or I have the chat box opened up. So whatever way y'all feel more comfortable communicating with me, that'd be fine. We're going to talk. We're going to visit for about an hour and a half on accounting and tax issues in small business. My name is Keith Neifach. It's right there on the cover sheet. I've been teaching for Collin College for about 32 years now. Long time, long time. And this is one of the free programs that's offered through the Small Business Development Center. Some of y'all might have used the SBDC as a free resource. Has anybody used the SBDC?
Yeah, I have used it and watched some of the seminars and meetings. They're very good.
Good deal. Good deal. Yeah. There's a couple others that relating to accounting and tax issues. There's a 9-hour program, and that's through Collin County Community College. It's a not for credit, and I think the fee is like $80 or so. There's a tax essentials class that talks about IRS matters. And from the IRS perspective, it's material put together by the Internal Revenue Service. And other than those in the UK, we're all subject to US tax law. So that's a good course. And there's a couple other courses. One is called Legal Aspects of Starting a Business and Legal Aspects of Running a Business, offered by Terry Travelin. Has anybody has taken or participated in any of those programs?
No.
No, no. Well, so I've known Terry. She teaches it. She's been teaching for about 13 years, and some of the material you're going to see. One of the exhibits I have is similar to what she goes over. We look at it from a little different perspective. I'm more of a tax guy. This time of year with the IRS and tax deadlines, we all get slammed in my profession. But I like to take a few minutes and visit with business owners, because obviously starting a business can happen throughout the year, not just near a deadline or away from a deadline. So with that, I'll move on to the first page of our handouts. I'll hold it up to make sure everybody's on the same page. Y'all there? Whoop. I got this background going, and I'll talk to you a little bit about that in a few minutes. Y'all got that page up there? You looking at it?
Yes.
I got somebody. Yeah, good. Okay. And so, when you were born, if you were born in the US, before you could leave the hospital, you got a Social Security number. And that number is associated with you as an individual. It's ideally not shared with anybody else. And throughout your life, that stays with you. You get one Social Security number. If you come to the United States and you work, you get a taxpayer ID number. And again, it's a unique number. Um, so that's as an individual. Now we're moving into the realm of a business. And I must say to you, the goal of a business is to generate profit. Um, there are organizations out there that are nonprofit entities. Y'all might attend a church, or you might be familiar with the American Red Cross, the United Way. Those are nonprofit entities. For-profit entities is typically a business. Some of you work for companies that are for profit. Some of you invest in companies that are for profit. If you invest in publicly held companies through the stock exchange, stock market, mutual funds, retirement plans, invest in them. You're investing in entities that are for profit entities, and that's the scope of what we're going to talk about in this class. It is for a business, not for a nonprofit. And we have somebody who's on this presentation who's in the UK. The rules in the UK are completely different than what we have in the United States. And my body of knowledge is really US. It's not foreign tax for international. So I'm gonna limit the scope of this to really US businesses. And so the exhibit I have here, and if you take some of the other classes, they use a similar kind of exhibit. I developed this about 30 years ago, so anybody who's been teaching for a shorter period of time probably copied this material and modified it for their own use. I have really 5 different columns here of business entities. The first column is a sole proprietor or sole proprietorship. Sole meaning, well, if I can get my finger in the screen, sole being one. There's a single owner. A partnership is more than one owner, 2 or more owners. And typically in a partnership, it does not require the government to approve the existence of a partnership. You know, I'm good at manufacturing a product. My neighbor is good at selling a product. We meet and we decide, I'll build, you sell, or I'll build, she sells rather, and we'll split the profits 50-50. We don't need the government to approve that business entity. Then there are the corporations, the C corporation, S corporation. Those require government approval. In order for me to create a corporation, I need to file with my Secretary of State. In this case, it's down in Austin. And the Secretary of State grants my business approval to operate. And it's called a charter. The state, Secretary of State issues a charter, and that grants my business the right to exist. Whether it's a C corporation, S corporation, or the far right-hand column is LLC, or limited liability company, LLC. Now, the sole proprietorship is a single owner. Partnership is 2 or more owners. A corporate entity or an LLC entity can either have 1 or it can have more than 1 owner. So there's no restriction on the number of owners, either being 1 or more owners when you have the C corporation or S corporation or LLC. And now I want to talk about the far left-hand column, which is the attributes or the characteristics that might be different among the different business entities. The first is legal liabilities of owners for business debt. When you think about a business first and foremost is responsible for its own debts. So when a business goes out and buys product from a supplier, it is the business that is obligated to pay back that debt first off. Always primarily it goes to the business. So the debt stays within the business. What I'm talking about here is the legal liability of the owners for the debt if the business can't pay the debt off. So for example, my business, I'm going to get my business started, and my business needs a forklift. And the forklift costs $100,000 to buy the forklift. And so my business goes to a bank and applies to borrow money to purchase the forklift. And the bank says, all right, we will loan you, because it's a $100,000 forklift, we will loan you $90,000 for the purchase of the forklift, and the business will have to put down the rest of it, which is the $10,000 difference. And that is called equity. And y'all, probably when you bought your first home or your second home, you had to put a down payment towards the purchase price of your home, your asset. Well, the same case in a business. A lot of times a business will borrow money and the lender will require the business to put in some additional funds to make the purchase. So in my example, the business bought a $100,000 forklift, of which they borrowed $90,000 to make the payment, and the business took $10,000 out of the business bank account to complete the purchase. Now we have a debt owed to the bank for $90,000. If the business were to fail, and the business owners say, look, this is not a profitable business, I think we should need to shut down. Well, the business still has an obligation to pay off that debt to the bank. So that $100,000 forklift that was purchased brand spanking new, that's been used a little bit, the business decides to sell the forklift because it's going to go out of business. So it sells the forklift. How much do y'all think a $100,000 brand new forklift is worth in a used market? Anybody venture to take a guess? I'll wait. I'm patient. Think of a new car versus a used car. Is that forklift that's used where it's still worth $100,000?
I'll guess $50,000.
$50,000. I'll take that. I'll take that $50,000 guess. So the business sells the forklift and gets $50,000. Well, you all are the bankers, and the business borrowed $90,000 to buy the forklift. I, as a business owner, come to you and say, well, I just sold the forklift. Here's the $50,000. Are you the banker happy about that? You just loaned the business $90,000. The business is paying you back $50,000 when it sold the forklift. Are you happy? Danny says no. Why aren't you happy, Danny? Do you feel a little shortchanged? You loaned 90 and you're only getting back 50? Of course you're not happy, because you feel that you loaned 90, you only got back 50. Who do you have a right to get the other $40,000 shortfall from? What's your recourse as the lender? Well, in a sole proprietorship, your recourse is against the owner of the business. The owner of the business is unlimitedly liable for the debts of the business. So in the case of my sole proprietorship borrowing the 90, paying the lender back the 50, the business owner, being me, is liable to pay off the balance that's owed. So you as the banker are probably pretty happy about that. That eventually you're going to get the full amount that was loaned, because you have the capability of piercing the business veil of liability and going back to the owner of the business. So Danny, a little bit happier now when you loan the business the money? Or is the boss happy? I'll go to Chad. Yeah, you're probably a little bit happier. Now let's think about this for a minute. I live in Texas. Texas is a community property state. So in a community property state, what that means is that my spouse is also unlimitedly liable for that debt. So for me to come up with a $40,000 difference, I might have to sell my vacation home, my RV, my boat, all my toys in order to pay off the bank. Well, some of those assets are shared by my spouse. She enjoys the boat, she enjoys the RV, she enjoys the condo. So the unlimited liability of the debt not only falls to me, but being Texas's community property, it falls back to my spouse also. Similarly, if my spouse owned the business and the business failed to pay back the debt, then my wife would be obligated to pay it, and some of my personal assets, my condo, my RV, my boat are all obligated to be liquidated to pay off the debt. In a partnership, Daryl, you and I are partners. Business borrowed $90,000, paid off $50,000 when the forklift was sold. In a partnership, the partners are also unlimited liable for the debts. So in this case, there's a $40,000 obligation that the bank is going to go back to Daryl and me and ask us to satisfy the debt. Well, all my cash is tied up in investments. Daryl has the money sitting in his bank account. The bank doesn't care where they get the money. They'll get all the money from Daryl, and what Daryl would have to probably do is sue me to get my share of that $40,000 repaid to Daryl, so that if we were 50-50 owners, I'd have to pay Daryl $20,000 to satisfy the debt. So in a proprietorship or in partnership, the owner or owners is unlimitedly liable, just as the spouses are, because it's a community property state. In a corporation or LLC, it's a little bit different. The bank loaned the business $90,000. The business sold the forklift for $50,000. The business that's a corporation or an LLC was short $40,000 paying off the lender. Well, in that case, the lenders cannot go back to the owners to have them put more money in the business. When you think about what equity represents the value that the owners have in the business. In a corporation or LLC, equity can only go down to zero. The value of my investment in the business can only fall to zero. When I owned stock in Enron, and Enron's stock value tumbled, it never tumbled below zero. I, as a shareholder, was never obligated to put more money in Enron to pay off the creditors. Where in a proprietorship or partnership, I could be obligated to put more money in order to satisfy the creditors. So the entity selection is critical from your perspective on whether you are going to be personally liable for debts of the business. It's equally important when you decide to sell your products and services to clients. If you are selling your products and services to my business, and my business failed to pay your business for the full value of those, your business wants to have recourse. You want to know who is ultimately going to satisfy that debt. So if my business was a corporation, then you're kind of out of luck. If my business is a proprietorship or partnership, then yes, you might have recourse against my personal assets. So not only is it important for you and how you operate your business, it's important for you and what kind of your business and what kind of relationships you have with other businesses, who you're selling to, who your customers are. Now, all this makes it a little more difficult in order for a small business, a new business, trying to borrow money. Because if I was setting up a new business and I wanted to go to the bank, and I created my business as a corporation, I went to the bank and I said, I need to borrow $90,000 for a forklift. You're the banker. Are you going to loan my business the money? I'm a new business. Are you going to loan my business the money? Knowing that a forklift probably will go down in value if you have to repossess it. Anybody care to chat in or speak up? Well, you might not be willing to loan my business the money unless you get something that's called a personal guarantee. Is anybody familiar with what a personal guarantee is? A personal guarantee says that the owners of the business will satisfy that debt if the business can't pay it off. So for example, if my corporation were to borrow the money and my corporation doesn't have the wherewithal to pay off the debt, then the lender, the bank, can go against me personally. No other creditor can go against me personally unless I've signed a personal guarantee. So it's very important that when we get a business started, to understand that a lender typically is going to want a personal guarantee, which means that the owners of the business will pay off the debt. And so that criteria or that provision allows lenders to loan money or to provide services or provide products to businesses that are relatively new. You know, I create the LLC because I'm worried about someone suing the business for something unrelated to borrowing. Is anybody familiar with the McDonald's cup of coffee lawsuit? Has anybody ever heard that story? Do you care to share Paula, what that story is?
Yes, from what I remember, there was a woman who was holding the cup in her lap while she was driving, and it spilled on her, and then she sued and she won the lawsuit.
Right. She won the and how much was that lawsuit? Do you
I
remember?
think it was $1 million
It
or
was a
something
million.
in the
Yeah, I mean, it was
millions.
an astronomical amount of money.
Mhm.
So think about in our business. Thank you, Paul. Think about in our business that we sell products and services. We don't know who we're going to get sued by. We don't know if there's going to be a lawsuit, who we're going to get sued by. And in fact, what kind of jury award would occur if we lost the lawsuit? So how do we protect ourselves from that? Maybe we buy more insurance. And so when we buy more insurance, we have higher insurance premiums, a higher cost of operating our business that passes on to our customers. Our customers pay more for our product, which means that they might have other choices. And so we try to limit our exposure. I mean, if my business is sued for the products or services I sell, and it comes back to me personally, that could bankrupt my family. And so I create an LLC or a corporation to limit my liability. But I also want to limit the types of jury awards and exposures I have that relate to my product or service. The best example, I can give you two examples. The first example is a ladder. Y'all have probably used a ladder, maybe hopefully in the last 5 or 10 years, you've bought a ladder and you realize, you know, my example is I have a 12-foot high ceiling. I can reach about 6 feet up. If I can get my hand in the picture, I can reach 6 feet up. So I needed a 6-foot ladder. So I bought a 6-foot ladder and I climbed to the top of the ladder and I changed the light bulb, but the ladder tipped over and I hurt myself. And so I decided, well, this was not a stable ladder. I'm going to sue the ladder manufacturer because I think they made an inferior and an unsafe product. So I sue the ladder manufacturer. I sue for the $1 million. I sue for $1 million. You are the jury. Are you going to award me the $1 million because the ladder was unstable? I climbed to the top, changed the light bulb. That's what I bought it for, and it didn't work. You all are the jury. I need somebody in the jury to speak up and say, are you going to award me the $1 million? Anybody? Daryl, you still out there with me? I think.
Yeah, I'm still here, Keith. My answer would be you would have to show that somehow the makers or sellers of the ladder knew that there was an issue with it. You know, that there was an issue with the ladder, not that it was an issue with you just not knowing how to use the ladder.
So you're what we call you're supporting big business. You're not supporting the individual. I'm your neighbor, Daryl. I live next door to you.
I understand, but
Do you have a ladder?
you have to show there was some negligence on the part of either the people who sold or manufactured the ladder versus just an issue with you using the ladder.
Okay. Do you have a ladder at home?
I do have several.
Okay. And is there any kind of warnings on that ladder?
Yes, there are.
Okay. Well, I told you I stood on the top of the ladder. And so
And
go ahead.
don't go beyond this step, right? That's all that
Perfect.
matters.
Perfect. And I stood there. I stood beyond the step. So Daryl, your point is that I didn't heed the warning.
Correct.
Is that fair? Am I saying that properly? I didn't heed the warning.
Correct.
Okay, so that warning says to the business says with the warning, if you use this product in this way and you become injured, you've been warned you shouldn't do that. So as the jury says, all right, because Keith didn't follow the warning, he was injured. It's not the business's fault because they gave the warning. Okay. And that's fair. That's great. That's what I want. Now, when you think about buying a cup of coffee now, if you all go to McDonald's, you go through Starbucks, on the side of the cup, is there, if I get my cup in, is there a warning? Doesn't that warning say it's hot? The contents may be hot? Sure it does. Because they don't want another lawsuit. They're afraid that if there's another lawsuit, it would sink the company, and therefore they put the warning on it so that the jury says, hey, he or she was warned it would be hot. We're not going to give them the award of judgment, the $1 million award. So that's two instances of warning the customer how the product should be used. Has anybody installed an application on their phone or a program on their computer? Has anybody ever done that? Downloaded something and installed it? You all have.
Yeah, of course, we all have.
Okay, so what is the first thing that pops up? Is it a yes or no? Do you agree or disagree?
A whole bunch of things that probably the vast majority of us don't pay attention to. We just
Okay.
click through so we could use it.
What do you guess it says?
That you agree to whatever they say.
To whatever they say. So which means if something, and really what they're saying is if something happens to your computer, if your data is destroyed, if it causes economic damage to you or your business, they cannot be held responsible. That's what the warning says. And we are so used to clicking through because the only way we can use the product is to click through, I accept or yes or whatever. And so it limits the liability that the company can have by doing damage to our data, doing damage to our business operation, by injuring ourselves, by burning coffee, by falling off a ladder. It does all those things. So you have to think in the business, in the products or services you sell, how do you limit your potential liability? Because I don't want you just selling a product or selling a service and saying, okay, I made the money, because you got to think about what's the back end. Who can sue me for what? What kind of damages? And how do I limit my liability? Because just because you have limit of liability in a business or you have unlimited liability in the individual, on the proprietorship or partnership, doesn't mean you don't have the headache of defending yourself. And you don't want it to sink your business. So the limit of liability and what you offer to your customers that they have to say accept or they click through or they you can't just peel the label off the letter and say it didn't exist. What they accept or what you accept of the agreements you have in your business could potentially affect your liability. And these liabilities can come in and sink a business, or they could cause a business to do much better because their competitor's business has been sunk by not having the proper agreements and understandings in place. So the limit of liability is not just creating a corporate entity and saying, well, that's it, I don't have to worry about it, or buying enough insurance to cover you if your business is sued. It's to head it off at the pass and put the warning labels on the product, put the verbiage on the product, or put the agreements or disagreements that people can't use it and then come back and hold you accountable for it. So that's the limit of liability. Maybe more than you ever wanted to know, but probably it's very important that you think about it from your standpoint as buying and selling a product or service, or buying product or service from one of your suppliers. Continuity of entity. This is critical when you think about your business. Now, I want to take a step back. Y'all are here about starting a business. And I have to tell you that the end game is not starting it. It's to build it and sell it. You know, I have behind me is a picture of a beach, a black beach in Hawaii. Has anybody been to Hawaii? Paula shook her head no. That was pretty quick. You'd remember. I mean, I've been there twice. When I was there, I thought this is where I want to live the rest of my life when I can retire. I mean, that's my dream board picture. I don't know if I'll ever get back there, but you know, the goal is not to do what I'm doing for the rest of my life. The goal is to build wealth, build value, sell it to somebody else, so that I can spend the rest of my life living the way I want, whether it's on a beach, whether it's mountain climbing, whether it's on a boat in the Caribbean Ocean, whatever, you know, or you know, whatever, or living on a family compound, whatever your dream is, it's probably different than mine. But typically, I don't meet people that say my dream is to have a business and have to get there at 8 a.m. and hire and fire my employees and manage my inventory and do the marketing. Those typically are not people's long-term dreams. They're a way to get to the long-term dream, the long-term goal. So I look at a business as being a way to build wealth, build value, to transfer to somebody else. If I have to be in my business every day, working in my business every day, if I don't have processes and people in place and relationships, I'll never be able to take a vacation. I have to be able to get away and let the business continue to operate and pay the employees and add value, add wealth, have customers, so that one day I can sell. You know, it would be a shame, and I've seen this happen time and time again, where a business buys assets, a business uses the assets to manufacture the product or service. The business owner gets sick and needs to sell or wants to retire, and they can't find anybody to buy it. So they shut down the business. And they bought that forklift for $100,000, and today it's only worth $5,000 because it's a 30-year-old forklift. And so what we try to do is we try to build value in a business. And does anybody have an existing business right now? Anybody have customers and vendors and products or services? Anybody have that?
Yes. Well, my
Right.
husband does. My
Okay.
husband does.
Okay, well, I'll give you a credit that you support him and it's a team effort. Okay.
Mhm.
So does he use a computer in his business?
I do all the paperwork. I do everything for him.
Okay, do you use a computer?
Yes.
Okay, what kind of computer do you use?
It's an HP, but I also have a Mac that I use.
Okay. Oh yeah, you got an HP and a Mac computer. You got some paper clips on your desk?
Yes.
You got a mouse on your desk?
No.
Okay, I'm sorry, I'm old school. Okay.
Yes.
You got some equipment. You got some equipment
Yes.
you use in the
Yes.
business, right?
Mhm.
And you had no hesitancy to give me the name of who makes the equipment, right? Right. You told me it was HP and you have a Mac, right?
Yes. Yes.
All right. So you
Mhm.
gave me those. Does your husband have customers?
Yes.
Okay. Don't answer yet. Would you share me the names and phone numbers of all his customers?
No.
No. Okay. So the equipment is a commodity. I can go out and buy an HP. I can go out and buy a Mac computer. I can go out and build a website. I can do all those things, but the most valuable asset of your husband's business and everybody's business out there is the customers.
Yes.
You know, heaven forbid there's a fire and that Mac and an HP machine got destroyed and your paper clips melted. You can replace those easily, right? In every business, we can replace those easily. The most valuable thing we can't replace, or that's difficult to replace, is our customers. And to some degree, our employees and our employee skills and the employee skills that who help us in our business. And so one day when a business owner wants to retire, it is the customer relationships that are most valuable that we want to sell to somebody else. So imagine you all having a business and you want to retire. And you told me you have a 30-year-old forklift and you got a 5-year-old Mac machine and you got a bunch of paper clips. I tell you, I give you very little for that. But what I want is I want your customers. I want your employees. I want your process. I want a machine that will tomorrow have lead generations. I don't want to build that from scratch. If I could go out and buy a computer today, I don't have the relationships that will generate income today or tomorrow. That would take me time to build up. And so if I'm looking to get into the line of work that you all are in that space you're in, I have two choices. I can start it from scratch and I can build it up. And I will bet you, all of you say the first months or maybe years of having a business, it takes a long time to get it going. Well, I want a machine that starts making money tomorrow. So what I will do is I will buy an existing business. I don't care about the forklift. I don't care about the printers or the paper clips. I care about the relationships. And if I could take on those relationships in my business, that affords you the capability of retiring or going to your beach, whatever you want to do. And the business will continue to make money, have value. You will get value from building a business and selling it as opposed to closing the business. I know a lot of business owners that say, look, I'm not going to sell. When I'm done, I'm just going to shut the doors. Well, imagine in Paula's husband's situation, if they shut the doors, what have they done? They might have terminated employees. They might have left customers who have no other place to go right now to get the services or products they need. So selling a business, building value and selling a business is really the ultimate goal of a business. It's not to get it open. It's not to get it started. It's to grow value, grow wealth so you can sell it, so you can move on. And that's really what a true entrepreneur does. I mean, we think about Elon Musk and we say, all right, well, he's an entrepreneur. He's really a business owner. He gets a number of businesses started. He really has yet to sell businesses. When you think of Tesla, they've been around for over 10 years. How many years have they made a profit? So if they haven't made a profit, it's difficult for him to sell. Where's the value? I would buy Paul and Paula's husband's business because it's generating a profit. There are individuals who buy what they call turnaround businesses, businesses that are losing money, and they're losing money because they're mismanaged. And if I were to buy a business that was losing money, I'm not going to pay a lot of money for those customers, for those employees, because those employees, those customers have not generated an economic profit. I'm going to have to do a lot more work turning that business around, making those customers, finding more customers like them, or selling them more product, or raising the prices so I can make a profit in the business. So it's going to be hard for me to get to wherever I'm going, my beach, if I don't have a business that is profitable that I can walk away from and still have the business, the process to continue on. Now let's go back to the continuity of the owner. And the continuity of the owner is, and reverting back to my first example, the business borrowed $90,000 from the bank to buy a $100,000 forklift. And after doing that, I decide that I'm ready for the beach. And and Chris comes along and Chris says to me, I want to buy the business. And I say, fine, okay, but just so you know, there's a $90,000 loan still outstanding with the bank on this forklift. You all are the bankers. Chris is going to be buying the business. Are you willing to remove me from the business and let Chris take over the ownership of the business? Doesn't matter to use the banker that Keith is retiring and Chris is taking over. Danny, are you with us today? Danny's on mute, and well, probably in a sole proprietorship, you wouldn't accept Chris as being an owner. You probably figured out, well, if the business doesn't pay it back because sole proprietorship, we can always go after Keith. Keith has the condo, he's got the boat, he's got the RV. We don't know what Chris has. In fact, even if Chris has a boat, an RV, and a condo, we don't know if Chris is underwater on those, if Chris has equity. We as the bank are not going to allow Keith to sell the business to Chris and get Keith off the hook. Because that's my main concern. When I sell the business, I want to be done with the business. I want to be on the beach. So by that, any business loans that exist in a proprietorship or in a partnership, I'm at the mercy of the lenders approving me to sell, which is a really tough situation to be in because health-wise or my emotions or my fortitude or my family's needs might say, I got to get out of business. I don't want to be doing this anymore. I find someone who comes along and says, hey, you got great customers, you got great employees, you got great processes. I want to buy it. But my banker's telling me, my creditors are telling me, no, Keith, we're not going to let you off the hook. And therefore, Chris might not be a viable buyer for my business because it doesn't meet the bank's needs. Well, in a corporation or an LLC, that's not the case. In those entities, I am able to sell my shares, stock in the company, my member units in the LLC. If there's a personal guarantee, yeah, I might have to pay that off, but I can sell my business shares to somebody else and let them take it over. And in fact, that's what I did yesterday. I own stock in General Motors. I sold my General Motors stock and bought stock in Ford. General Motors continues to operate. The banks, the landlords, the lenders, none of them cared that Keith is no longer a shareholder in General Motors because General Motors is a corporation. Businesses that are corporation, typically the lenders, the creditors don't care who the shareholders are unless there's a personal guarantee. So continuity of entity is critical when we consider our exit strategy. Exit strategy means the owner is getting out. How does the owner get out? When does the owner get out? Transfer of interest, continuity of entity, both the same thing. Acquisition of credit. We live in a world of credit scores. And everybody here, everybody on the call has a credit score. It's based on your history, your performance, how much money you've borrowed in the past, how diligent you are in paying that money back. What is your household income? I mean, there's a lot that goes into the credit score. And the acquisition of credit, the lenders typically look at the owners of the business. And they say if the owner of the business has been diligent in paying off their obligations as they come due, has been diligent in not overextending themselves personally, then more than likely any business they're involved in will have the same philosophy. So I've been a Dave Ramsey ELP. Does anybody know who Dave Ramsey is? Yeah. Okay. So, Dave Ramsey, the philosophy really is you get out of debt, you pay off debt. You don't make the banks wealthy. I go into a bank lobby and it's made of marble and granite and it's got beautiful wood. And, in some cases, I'd rather live in the bank lobby than live in my own home. Okay. But who pays for that bank lobby? It is the customers who pay. And so if I'm paying interest to a bank, I'm helping the bank build those beautiful palaces. So I don't want to do that. I want to build my own wealth, not build bank wealth. And so I try not to go into debt. Well, in some cases in businesses, we have to go into debt. I mean, there's no way my business can afford a forklift. to operate. I have to borrow the money to do that. Maybe the next forklift I buy, I'll be able to pay cash for it. I'll save up and plan for it. But it costs a lot of money at times to get a business started. And so lenders look at how I live my life and say, if Keith doesn't go into debt, or he's very, he pays off his bills on time when they're due, then a banker's more apt to loan a business that I own money. If I have not shown that responsibility, if I have a lot of late payments on credit cards, if I've had some credit card forgiveness, if I've had some short sales on homes, I've walked away from rental property mortgages, I've broken leases with landlords. If I haven't shown via my credit score that I'm responsible, then a banker's going to say, well, that's probably how he's going to run his business. If he runs his business that way, then there's a greater likelihood the bank is going to have to call in notes, have to foreclose on assets, and bankers don't want to do that. They don't want to get involved with that. So the acquisition of credit first looks at the owner's creditworthiness. Then it looks at the business's capability of paying off the loan. So again, in the example, my business needed a forklift, and the debt service on that forklift is $2,500 a month. The lender will say, all right, is the business making enough money to make the monthly debt service payment on that piece of equipment? And so when we can show to the bank that the business has the capability of paying off that monthly payment, then the lender is more apt to make the loan to the business. Similarly, when you sell your products and services to other businesses, to other individuals, well, certainly to businesses, it's great if we can sell all our products and services for immediate payment, cash on delivery. When I go into the grocery store, I go into Tom Thumb and I make a purchase, I have to give my credit card. I pay for that at the register. Well, when we sell our products and services B2B, from my business to another business, typically they want terms. They want time to pay. Either they pay in 10 days or 30 days. And so I'm looking for their wherewithal to pay my business when the bill is due. If a customer comes to me and says, Keith, I want to buy your product and I want 30 days to pay, I can either agree to that or disagree. I can say, no, I need my money immediately. Or I might say, all right, I'll give you 30 days to pay, but I have to charge you interest for that 30 days. But I agree to that term. I say to the customer, if I'm going to sell it to you for 30 days, these are the terms. In 30 days, I expect you to pay. If the customer doesn't pay in 30 days, do you think I get nervous? Yeah, you bet I get nervous. Now I'm wondering, why isn't that customer paying my invoice in those 30 days? Well, within the 30-day term. So I'm scrutinizing the businesses that I deal with, just like I know the banks are scrutinizing any kinds of loans that they're making to my business. And it all comes back to my creditworthiness and my business's ability to pay off its debts. That is acquisition of credit. Any questions about what we've covered, what we've talked about so far? I must be doing a bang up job, I'll tell you. Now, like I said, I've been teaching for about 30 years. My wife is a CPA. My son is a CPA. He works in industry. He's not in public accounting. And my daughter, she's a chemical engineer. So they're gone. They've left the nest. We got the dog. You haven't heard yet from the dog, but it's the three of us. And all these years I've focused in on tax matters, tax issues. That's my area of expertise. And I got my master's at University of North Texas up in Denton. Anybody go to school up there? I live in Plano. It used to take me 22 minutes to go from Plano to Denton. If I can get it done nowadays in an hour and 22 minutes, I'd probably be happy. But all these years, taxes, taxes changed dramatically when Ronald Reagan back in '86 had a tax act. Then for 30 years, things were pretty stable. And then in 2017, we had a tax act that changed things dramatically. And then we've had tax changes along the way. In fact, just last week, we just have a new bill in place for a tax act that retroactively changes things to 2020. So a number of tax returns we've filed have to be already amended, which is kind of interesting. So taxes, I used to say, they don't change that much. For that 30-year window, they didn't. But now now they seem to be changing daily. If you're in Texas, we have an extended due date to June 15th rather. The rest of the country, they just extended it to May 17th. So we have a little bit more time, but federal taxation of income is always kind of interesting. Obviously, maybe not to you, but to me. I want you to think about what you've had in the past. In the past, you've had a W-2 from an employer, more than likely. You got a job. You have a job. And from that job, as you made money, there was taxes withheld from your earnings. And when you filed your tax return at the end of the year, you got a little refund, or you owed a little bit, and things were pretty stable. I remember my son, when he got his first job, he was making $10 an hour. He worked 10 hours that week, and he thought he was going to get $100. And mathematically, yeah, that's what he earned. That's not what he got. Because what he got was a paycheck that had federal tax withholding, Social Security, Medicare tax withholding. So his $100 paycheck got cut to about $83, and he was mad at the government. And I think to some degree, we're all a little bit mad at the government in one way or another. But having a job means is you got paid, so did the federal government. And at the end of the year, your tax return was just reconciling how much you really owed, how much you paid in, and you owe them a little bit more, you get a little back. Well, times are changing when you have a business. In a business during the year, the federal government doesn't know how much you make. So at the end of the year, you have to file the tax return that shows what the total business earnings were, what the total business expenses are, and that net profit is what taxes are owed on. And so you can see in a sole proprietorship, the profits are taxed directly to the proprietor. So if my business billed out $500,000, and it had $400,000 worth of expenses, the net profit is $100,000. As a sole proprietor, I pay tax on $100,000 of profit. Just like if I had a wage of $100,000, I would pay tax on $100,000 of wages. So in this case, my proprietorship had $100,000 of profit. It owes federal tax because my wife we filed a joint return. Our tax rate is essentially 20%. I owe $20,000 in federal income tax on my $100,000 of business income. Okay, that's fine. But in addition to the federal tax, I owe something called self-employment tax. Now, somebody here must have paid self-employment tax in the past. Anybody care to speak up or chat in? Well, think about the job. In my job, as I earned wages, Social Security, Medicare tax were withheld from my earnings. And at the same time they were withheld from my earnings, my employer matched that. They paid in Social Security, Medicare tax. So essentially, Social Security, Medicare tax are about 7.65% of my earnings. The employer matched 7.65%. So the federal government got about 15.3% Social Security, Medicare tax. Well, that 15.3%, because I'm self-employed, because I have a business now, the federal government wants 15.3% of my earnings. So self-employment tax is the Social Security, Medicare tax that was paid by the employee, would have been matched by the employer. The federal government gets it in self-employment tax. And this is a real shock because now my wages were, my business earnings were $100,000. I owed $20,000 in federal tax and another about 15% self-employment tax. So I owed a total of about 35% tax on my $100,000 of earnings. Well, the first year I wasn't planning on that. I didn't know that self-employment tax was going to kick in. The second year, now I became educated. So in the second year of my business, I knew I better start setting aside about 35% of my earnings to pay my tax bill. The federal government says this tax obligation is a joint, it's on the federal tax return that is a joint return with my wife. So it doesn't matter to the federal government which one of us pays the tax. It's paid with the tax return. So my wife wasn't too happy either when I did a tax return and said, well, we owe $35,000 in tax. And she's thinking, wait a minute, we don't have that in the bank. What do we do? Well, because I have control over the business, I could have taken money out of the business. If the business made $100,000 of profit, I could have taken money out of the business and remitted that money to the IRS to pay in what they call quarterly estimates, to get some money to the government during the year so there's no big tax bill at the end of the year. So the quarterly estimates accomplish that goal. If I took that $100,000 in profit and said, hey, honey, we made $100,000 profit in the business, let's go out and buy a nice big boat. I think you can buy a boat for $100,000. We went out and bought a $100,000 boat. I do the tax return. We owe $35,000 in tax. What do I have to do? I got to sell the boat. I don't get $100,000 for the boat. Now I only get $60,000 for the boat. I lost money on the boat because I didn't pay the IRS first. So when I have a business that has income tax owed by the individual, I want to make sure I pay my taxes first. And then after all that's done, after all the dust settles, if there's money left over, then maybe I can afford to buy the boat or save up for the beach. So in a proprietorship, the taxes are paid directly by the proprietor plus self-employment tax. In a partnership, our business made $100,000 of profit. You and I are 50-50 owners. I owe tax on my 50% of profit or $50,000. You owe income tax and self-employment tax on your 50% share of that profit. And so I'm in the 20% tax bracket because of my spouse's income. You might be in a different tax bracket, but we probably both owe the self-employment tax. In a corporate entity, the C Corp or the S Corp, the first thing to be concerned about is you have to be, if you are working in the business, you have to get a wage. You have to get paid a W-2 wage. From your W-2 wage, Social Security and Medicare taxes are withheld. So you can see in the S Corp, there is no self-employment tax. Social Security and Medicare tax are calculated on your wage. And when you create a C Corp or an S Corp, you get a nice letter from the IRS that says, congratulations, being a corporate entity, you have to pay yourself a reasonable compensation. And so make note of that term, reasonable compensation. You're going to want to Google that, learn more about what all that means and how it's calculated. But whatever profits are left over that are distributed to the owner, there is no self-employment tax. There's no Social Security and Medicare tax on those profits. So in an S Corp, again, the S Corp made $100,000 after paying, well, let's say it made $100,000 and I took a wage of $20,000, which means after my wage, the profits were $80,000. In the S Corp, I receive $80,000 of profit recognition. I pay federal income tax on my $80,000, but I pay no self-employment tax. So the C Corp avoids self-employment tax. I'm sorry, the S Corp avoids self-employment tax. The C Corp is different. It's a completely different animal. In the C Corporation does not allocate the profit to the owner. In a C Corporation, in my example, the business made $100,000, then I took a $20,000 wage. The C Corporation had $80,000 after my wage. the first thing the C corporation has to do is pay federal income tax on its profit. The C corporation is the only entity that pays federal income tax. The federal income tax on the C corporation, for lack of better, is about 21%. So the C corporation pays 21% of 80,000 bucks, about, if I could do my math, let's do 16,000. Let's do 16,000 even. That'll be easy. So after 80,000 profit, $16,000 of tax, it now has $64,000 of after-tax profit. The C corporation can do one of two things. It can either retain the profit in the business and use that $64,000 to buy more inventory, buy more equipment, to grow, or it can pay out a portion of the $64,000 as dividends to the owners. When the owners receive the dividend, they pay tax on receiving the dividend. So even though that profit was taxed at the corporate level, the C corp level, when a recipient gets the money, they pay tax again. It is double taxation. And this has been an issue. The 2017 Tax Act lowered the C corp tax rates. If you followed those conversations before, they were trying to incentivize companies like Apple to pay more federal tax instead of keeping money overseas. They try to encourage companies to pay more in federal tax. And what that effectively did was it will eventually cause individuals to pay more tax, right? Because the federal government, this is no secret, federal government needs some money to operate on, right? They have to buy the planes, they have to pay the benefits, they have to pave the roads. I mean, whatever the federal government needs, if they get less from corporations, they're going to have to get more from individuals, right? Because I've very rarely heard about federal spending being decreased overall. But we don't want to get into the economics of it. I just want to make you aware. C corporations pay double level of tax on the profits when they're paid out in dividends to the shareholders. Corporations that are capital intensive, when you think about General Motors or Tesla or General Electric, they don't pay out a lot of dividends. They use the profits to build more factories, to buy inventory, to buy land, to make capital improvements. They don't pay dividends out to the shareholders because they feel, let's grow the business. Other businesses that are not capital intensive, the owners say, look, if the business has 100,000 profit, I want to take that profit out every year so I can enrich my standard of living. I want to buy the boat. I want to buy, I'm going to use that money for my personal well-being. So a business such as that is typically not going to be a C corp. They're typically going to be a partnership, a sole proprietorship, or an S corp, because the owner will take the money out every year. The business doesn't need the money. And then we get to the far right-hand column, which is the limited liability company, or LLC. So in the LLC entity was created in Texas in 1989, and every state has their own definition of an LLC. So a corporate entity in Texas is reciprocal with a corporate entity in Oklahoma or Nevada or California or Delaware or New York. All the states, it's a uniform corporate act. The LLC, every state has their own definition. Just because you have a Texas LLC doesn't mean Oklahoma will recognize it. So the IRS said, look, we don't want to get involved with 50 states plus the District of Columbia plus Puerto Rico defining what their entity structures are. So we're going to say when you create an LLC, by definition, by default, a single member LLC is taxed as a proprietorship. A multi-member LLC is taxed as a partnership, or the entity can elect to be taxed as a C corp or an S corp. So the LLC entity in and of itself is not a tax filing with the federal government. It has to, by default, it's a single member sole proprietorship, multi-member partnership, or election C corp or S corp. Now, which gets us a little further along into the Texas taxation of income. So before I get into that, do you have any questions about corporate tax, business taxes? Y'all are a quiet group. Makes it more difficult because I got to carry the ball into the end zone, which I might need to punt a little bit here.
Okay, I'll help you out.
Okay, go
I have a
ahead.
question. Okay, so my husband, he has an LLC. We recently switched over to a new CPA who suggested that we fill out Form 8832, I believe it was. And so I guess that makes us, if you could confirm this, does that make us now a multi-member? What did you just say? Multi-member partnership or no?
Okay, so what? So if you is it a Texas LLC?
Texas, yes.
Okay, so are you both listed as a member?
Now we are, I guess.
Okay, before you were a single member LLC.
Mm-hmm.
Okay, so by default, it was treated as a sole proprietorship. Now you are a multi-member LLC. Now it's taxed as a partnership.
Okay.
Now you can elect it to be taxed as a corporate entity.
Okay.
And when you elect it to be taxed as a corporate entity, then it could be a C Corp or S Corp.
Okay.
But
I know that the reason we switched CPAs is because our one that we had been using for 20 years or so, he really just, I think, only wants to work with people who don't have businesses, just, file their personal income taxes. But my husband now has 4 businesses, and feels like the accountant that we had used just isn't, I don't want to say experienced enough to do it, but we're probably better off just using someone who has expertise and experience, I should say, in, helping business. So my husband and I believe that we were just paying way too much in tax. And so that's why this new accountant suggested, well, if you fill out this form 8832, then I can be on, I want to make sure I'm understanding this right, but
well, you will become a member.
yes.
Okay. Now the thing to be mindful of is when you're the member, there's going to be self-employment tax paid under your Social Security number.
Okay.
So, and some of this is a retirement planning perspective on this, because depending on who is older, that person is more likely to start collecting Social Security sooner.
Mm-hmm.
And so you might want to attribute more of the income to the older spouse
Yes.
so that you earn greater Social Security benefits at a sooner point in time.
Okay.
So did you have an attorney help you create the LLC? Or did y'all do it yourself?
I'm trying to think with that one.
Well, let me back up. Let's back up. Do you have an attorney that you work with? Or not really? The answer to that is no then. Okay.
Yeah, no,
Okay.
but
All right.
well, no.
All right. So some of
Well,
it.
no, that's not true. We did speak with yeah, I would say we have one now. Yes.
Okay, so I would reach back out through an email to that attorney and say, would there be a benefit to having Paula as a member of the LLC? Because I'm sure you could be on the bank account, you could be, you could have check signing authority. Some businesses are adding both spouses because they want to be a minority owned business for contracts.
Mm-hmm.
And that's there's advantages for some government contracts to be a minority owned, a woman owned business. So having 2 members, one being a minority owned. I don't like the word. I don't like to use the word minority owned. By who owns the majority of the stock could
Mm-hmm.
help get contracts. So some of it is a retirement planning matter when I talk about Social Security. Some of it is the types of contracts that your business is going after that could cause a benefit to having both spouses as an owner. But because you file a joint return, your tax obligation probably isn't going to shift.
Okay.
Being a single member LLC, you are probably taxed as a sole proprietorship.
I believe so, yes.
When you do a multi-member LLC, now you're going to be taxed as either a partnership or a corporate entity, which causes there to be another tax return that has to be filed. And if you're
Okay.
treated as an S corp or a C corp, then there's going to be you have to get a wage from the business if you're working in it, and there's going to be payroll tax returns that have to be filed. So there's a little more administrative burden. Got it? Because the business
Yes.
has now employees. And so all these added burdens have to be offset by added benefits. It's not for the convenience of the tax preparer that you do it.
Mm-hmm.
You look long range and you say, what is this going to do for us? Either getting contracts in the next year or two, what's this going to do for us 20 years from now when one of us is eligible for Social Security? That's the long view of it.
So one of us has to be on payroll then?
If
Or-
it's taxed as a C corp or S corp, one of you has to be on payroll.
Because
Who's ever
last
worked-
year, yeah. Last year, I had myself on payroll for 3 quarters, and then for the last quarter, I took myself off payroll. But I need to get back on payroll, sounds like.
Well, it was a single member LLC last year.
Yes, it was.
So you were on payroll, but you were not an owner. So you didn't really have to be on payroll.
No, I didn't.
Right. I
didn't.
mean, you were in the fourth quarter, you were acting as an uncompensated spouse of a business owner,
Yes.
which again, it depends on how long you're married and what kind of challenge you have, but it's like, I don't want to work for free. So, but that's a different, I don't want to get your husband on the phone and getting yelled at, but.
That was him trying to call me just now, which I probably need to get to, but,
Okay.
okay, but that has helped.
Okay. Let me move on a little bit into Texas taxation of income. I moved here from New York State. My wife, I didn't know her at the time, but she moved down here from Michigan. Those states have a state individual income tax. Did anybody move here to Texas from other states? Has anybody moved from California or Oklahoma? Oh, Chris is from California. Hey, remember when you had to file a state income tax return, Chris? Yeah, you do. Okay, so the states, we pay higher property tax. So I've been told. I'm not sure about this, but we pay higher property tax, but we have no state individual income tax, which when Chris got here, there was a sigh of relief probably. And until you have to pay your property tax and you say, what decision did I really make? But in fact, Texas, we had a referendum, I think it was last November or last May, where people voted to say whether they want an individual income tax. And I've been here for over 30 years, and I can guarantee you in my lifetime and probably my kids' lifetime, we will never have an individual income tax. Chris, as much as I like California, I don't want to copy their mode of taxation, and maybe you don't either. But the state relies on oil royalties, energy royalties, top rate. That's where the bulk of the state gets its money for road construction, for schools, for everything that Texas does. And we all know what's happening with energy prices right now, right? I mean, oil production is down, royalty severance tax is down. The state is running into budgetary issues. Be that as it may, the state cannot collect more money from individuals because it doesn't collect any money now as an individual income tax. But what the state did in '89 when they came up with the franchise tax law was they came out and said, all right, we are going to assess a tax on businesses that have a limited liability. And so in this case, in a business that has more than about $1 million in liability, we're going to assess a franchise tax My guess is if in the first year of your business, you're not going to pay the franchise tax because you don't know it. But as your business grows, it's not a function of the profit of the business, it's a function of the revenue. So if your business collects, and right now the threshold is about $1 million. If the legislature was meeting now in Austin, lowers that threshold to 800,000 or 400,000 or 200,000, whatever they do, it could subject more businesses to this Texas franchise tax. But we have currently no state income tax on individuals. It is on LLCs that are taxed as sole proprietorships. So just be aware of the taxation of income. The other part of this conversation is if you are a Texas-based business selling into a state like California, like New York, like Michigan, you might be required to pay California or Michigan or New York State income tax because you're generating a profit in those states. So you have to be mindful of where you're selling. In a lot of states like New York, they're really going after businesses that are selling into their state. So if all you're doing is selling within the borders of Texas, then you're not subject to any other state's requirements. But if you do go out of state and make sales, or you go visit states for the purpose of generating sales that turn into leads and close sales, then you might be subject to state income tax. That's really the first page of the exhibits. I know I've been talking long, and you've all been chatting. I appreciate that. Let's go to the next page of the handouts. I gave you a balance sheet. Inanimate objects don't appear that well. There we go. The balance sheet. Hopefully you all have it. My business owns assets. On the first page, it owns money in a bank account. It has some furniture and equipment. It has assets that it owns. My business owns a computer. That computer's sitting in my business office right now. I'm talking to you on a home computer that I bought. It's my personal asset. I don't list it as a business asset because business doesn't own it. I drive my car to conduct business. It's not owned by the business. It's not a business asset. These are assets solely owned by the business. The next page are the liabilities. These are the debts of the business. So my business owes some trade payables. It owes some payroll taxes to the government. The business borrowed money on a line of credit. So these are debts of the business. I use my personal credit card to buy business supplies. The credit card is issued to me. It is my debt. I submit an expense report to the business for purchases that I made that the business owes me back. It has to reimburse me. That is a liability to Keith. It's not a liability of the business to Citibank. It is a liability of the business to Keith. Keith personally owes the debt to Citibank. So my credit card, the credit card liability is not a business debt. It is a personal debt. The assets are about $50,400. The liabilities are about $38,000. Meaning, if I could sell all the assets for $50,000, I could pay off the creditors who are owed $38,000. That leaves about $12,000 in the business, of which all the creditors have been satisfied. The only party that has a right to that money then is the owners, the stockholders in this case. That is the equity of the business, the amount that the stockholders are owed. So if the assets were only 20,000 and the liabilities were 38, then the equity would be negative 18. In order to pay off the debts of the business in totality, the owners have negative equity. The owners theoretically would have to put money back into the business to pay off the creditors. We know in a proprietorship or partnership, they probably would have to. In a corporate or LLC entity, they probably wouldn't have to. But the calculation of assets, liabilities, and equity are based on what the business owns, what it owes to third parties, and the net of what it owes back to the owner or what the owner owes the business. Assets, liabilities, and equity. The next page is the income statement. Any questions about the balance sheet, by the way? Oh, okay, I'm rolling along. Income statement. The income statement shows the revenue of the business over time. The balance sheet, if you look back on that, is a snapshot. It is as of that day. If you log into the business bank account, it would have the business balance of about $25,000. That picture changes tomorrow. On a daily basis, the balance sheet changes what the business owns, what it owes, and the equity. That's a snapshot. The income statement is measured over a period of time. Typically, the income statement starts January 1st and it grows, starts January 1st and it grows throughout the year through the end of January, through the end of February, March, April, through all the way through December. So in this case, I gave you just a 1 month snapshot from the beginning of the year of January. For this month, it had income of about $17,000. That is everything that's been billed out, not necessarily collected, but that's the result of the work that we've done in the business. We were able to bill out about $17,000 worth of work. During the month of January, we incurred expenses. I had salary expense to employees. I had health, medical insurance. I had rent expense, supplies, accounting fees. I had about $6,100 worth of expenses. For that month, we had about $11,000 of profit. Not a bad month. If I were to offer my business for sale, and I told you that, I want to sell my business to you, and I will sell it to you for my equity of $12,000. That's what I have invested. That's the value of my interest in the business. Would you buy my business from me? Would anybody buy my business from me? It's $12,000. Well, you look at the income and you say, of that $12,000, you're going to have to pay for that. How much income are you going to make? Well, you're going to make $11,000 a month. Is that a good investment? Somebody better snap up this business. If I could pay $12,000 for business and made $11,000 a month, that's pretty good work. Right? But I'm not going to sell you this business for $11,000. I'm sorry, for $12,000 that makes $11,000 a month. I'm probably going to ask $100,000 for this business, $150,000, because this is a profit-making machine. This has good customers. This has low overhead costs. This is a great opportunity, and that's how I'm going to sell it. I'm not going to sell it to you and give you a great opportunity. I'm going to try to maximize how much I can get for the business. So when you look to buy a business or you look to sell a business, you're looking at how much do you have to invest in and how much is that business going to generate. So the balance sheet needs the income statement information. The income statement information needs the balance sheet. If I told you I had a business made $11,000 of profit, do you want to buy it? But I told you it's going to cost you $2 million to buy it, you'd probably say no, because you need to know what is the equity? How much do I need to put in to get to own this business? So the balance sheet and the income statement are the two prime financial statements that are used in a business. The next page I'm giving you is called Profit Margin Management. This is probably my favorite exhibit. Every business, I would hope, could be profitable, and that's what we have in our base. We have about $1,000 of net income. Well, how do we generate more profit? How do we maximize our profit? Well, we have 5 scenarios written here that allow a business to try different strategies to maximize profit. Number one, we increase the selling price by 2%. If I charged all my customers 2% more for everything they're buying, look what I've done to my profit. I've tripled it. If I increase selling level by 6%, so, if I sell paper, somebody's calling me up for paper, I'd say, do you want to buy paper clips? Do you want to buy some staples? Do you want to buy some add-on items? If I could sell 3% more to, or I'm sorry, 6% more to my customers, look what I do. I increase my profitability. I decrease cost of goods sold. I go to my suppliers and I say, I've been buying toner cartridges from your company and from your competitor. If I buy everything from you, will you give me a better price on all my purchases? So can I get a bigger volume discount? So decrease cost of sales, decrease expenses, or a combination of the two. So we always look to maximize profit. If you're selling a business and I'm going to buy it, I'm not going to be satisfied with your profitability. I'm going to want to increase profitability. Because probably if I'm buying it from you, I'm going to have to borrow money to do it. I have debt service. So the business needs to make more money to satisfy the debt. So I look at increasing profitability. The next page, I gave you some resource, an IRS publication resource. A lot of us use our vehicles in business. And so we want to know what's available in terms of keeping track and claiming an auto deduction for use of our business vehicle. Most businesses that I talk to through this class, the business doesn't go out and buy its own vehicle. They use the owner's vehicle to conduct business. So this page and the one that follows is an exhibit to say when you get to count business miles. So you might find that to be helpful. The last topic is workers. As you're going to learn in your business, you can't do everything yourself. Paula, what's your husband's first name?
His name is Igor.
Igor. Okay, Igor can't do it all himself.
Right.
So Igor, as most business owners realize, they have to rely on people. And so Igor had a choice. He can either hire an employee or he can hire a contractor, an independent contractor. And so from that perspective, hiring an employee means you have to pay payroll tax for the employee. You might have to offer them health insurance, retirement planning. You might have to pay them for taking days off. They get sick days. They might get vacation days. That's versus an independent contractor. In an independent contractor, you say to the contractor, look, I'll pay you $20 an hour. I budget 20 hours for the project. It's a $400 project. You want to take the project on or not? I pay you on your deliverable. And once I pay you on your deliverable, we're done until I need another deliverable from you. So an employee is integral to the business, an independent contractor is not integral to the business. The IRS does not like independent contractors. The Texas Workforce Commission doesn't like independent contractors. They would prefer all workers are paid as employees. That way the federal government gets all their money. As the employee gets paid, so does the independent contractor, so does the federal government. Texas Workforce Commission likes employees because when the worker is terminated, the worker wants benefits, and the Workforce Commission cannot pay benefits to independent contractors. They can only pay them to employees. So there's a lot of stress on a business to only hire employees. Well, my business, as Igor's, I'll speak on behalf of Igor. He doesn't want to terminate his contractor and have the federal government or the Texas Workforce Commission come after him and say that worker should have been an employee and taxes should have been paid on their behalf. So Igor said, the only way I'll hire a worker is to hire them as an employee, which costs the business more money. So that's probably what Igor did. And he hired somebody he could rely on and paid him as an employee. Igor had the choice of hiring an independent contractor who is through an agency, through what they call a third-party administrator or a a contractor provided by a company. And so what Igor could have done was Igor could have hired my company to provide a worker. If Igor were to pay my company, that is not a payment to me as an individual. It's paid to my company, and my company is a corporation or LLC. That payment can never be reclassified as a payment to an individual. It is always payable to a business entity. Because it's paid as a business entity, then the business, Igor, in that case, would never worry about that being reclassified as a payment to an employee. So in order for my business to get contracts with other companies, I might have to incorporate my business or treat it as an LLC so that I can provide assurance to my clients that payments to me will never be classified as being paid to an employee. So, and we're going to find, as we found the last 3 years, is that more companies will not hire individuals as contractors. They will only hire corporations or LLCs and have those entities be responsible for the payroll and for the benefits to its workers. So there's a lot of good research about independent contractors and employees. The IRS on the page 11 of this handout has some testing they do, whether economic or financial relationships with workers. The more a business relies on a worker, the more integral that workers have to be treated from the business standpoint, and therefore the more apt the federal government and the state government looks at that as being an employee. The less integral that worker is to the business, the more apt they'll be treated as an independent contractor. So I know I flew through the last couple exhibits pretty quickly. Do y'all have any questions? Some of you have been kind of shy, which now's your chance. Let's see, Chris asked a question. If the value of equipment goes lower by period of time, how does the S go down as well? On the balance sheet, thanks for that question. On the balance sheet, there's something called accumulated depreciation. And that records the decline, the estimated decline in value of the asset. So for example, the forklift that the business bought for $100,000, if we say it's only going to last 10 years, then every year it goes down in value by $10,000. But that is an estimate. At the end of 10 years, the book value of the asset is zero. 100,000 original purchase price, accumulated depreciation 100,000, book value of zero. However, our business might continue to use that forklift for years to come. On the books, it's written off to zero value. But economically, it might have some value. And if we decide to sell at the end of 10 years, we might get $8,000 for that piece of equipment. So the true value of that equipment at the end of its life is what determines whether we have a gain or a loss, because over the 10 years, we've written off $100,000 of equipment. But in the last year we sold it, we now get back $8,000 of that because we sold it. So we had expenses over 10 years of 100,000, and then we have income of 8,000 in the year we've disposed of it. So that was a good question. I have to run to another Zoom meeting. Can I use the laptop purchased 2 years ago to expense my business? Yes, but if you have a piece of equipment that you've owned in the past that you are now converting to business use, you have to look and say, what is the value of that equipment on the day of conversion? So a laptop I bought 2 years ago for $1,000. A used laptop like that might only be worth $300. So now I'm contributing a $300 asset for use in the business, and I would start depreciating that $300 asset. So yeah, the first decline in value of the asset when it was personal, there's no deduction for that. It's just when I convert it to business, now I start, what is the used value of that asset? Let's see, thanks for, even if my laptop is a gift from my husband, well, no, it doesn't matter where the laptop was acquired from. The fact that you could have gotten it as a gift, you could have purchased it, it doesn't matter where it came from. To you, it has a value of on the day you convert it, what is the value on the day you converted it? Because I got, in your example, I got news for you. Your husband bought it. It was personal to him. So somewhere along the way, it was personal, it was personal to y'all. Now it's converted for business use. And I've had that happen quite often where people, they convert a personal asset to business use. And on that day of conversion, it then becomes a depreciable asset. How it was acquired is secondary. Anybody else? Text it or chime in. I try not to speak too fast, but well, that's all I have. I appreciate y'all participating. Even if you didn't chime in, I appreciate knowing that some of you are out there, and it kept me going. So there's a phone number. I'm sorry, there's an email address on here. If you need to reach out to me, that's fine. Hopefully I'll get to see you again on another seminar. And if you take this again, I will offer it again. I think it's September. If there's something I didn't cover in this material, I'll be happy to go over it when I do this again. So thanks, y'all. I'm going to disconnect so I don't get dinged. Have a good day, y'all. Thanks. Bye now.